Welcome back. Stocks edging higher today to kick off the last full trading week of the year. The Dow on pace for a fourth straight record close. So who better to join us now than Michael Lee, strategy founder Michael Lee. Mike, so great to see you. I want to start by getting your take on how long this has to last, because what we're seeing in the market really contradicts what we're seeing with the American consumer, right? Low personal savings rate, record credit card debt. So does this discrepancy start to manifest when companies report earnings next quarter? Or do you think there's a longer runway for this bull market?
Well, look, I think in the near term, 40% of the stocks, the S&P 500, are technically overbought at the moment. That's only happened twice in history. One was June of 2020, and the other time was June of 2003. And when that happens, those were the starts of pretty big bull runs. So at the moment, I don't think anything is stopping this, but you're absolutely right about the economy. What's baked in for next year is 10 to 12% earnings growth in the S&P 500. I don't see how on God's green earth anything like that happens. But then again, I've been surprised before. At some point, the stock market is not the economy, and the economy is not the stock market. But at some point, these two forces have to converge. And I think it's at some point something's going to happen soon. And that doesn't necessarily mean a correction. That means a sideways market until the economy, in effect, catches up to the market.
Michael, this has been the year of the Magnificent Seven. I wonder in 2024, given what you just said about earnings, do you see any of them continuing to be particularly magnificent? What are you buying?
Well, Brian, that's a great point. And so part of the reason why the Magnificent Seven has done so well this year outside of NVIDIA and Tesla is these companies are the new defensive stocks. Google's business is basically bulletproof, as is Facebook and Microsoft. So a lot of these companies also have the cleanest balance sheets and are the most recession resistant. So, it would make sense that in a slowing environment, you have such concentrated leadership. I think in the short term, you may see a broadening out of this rally. But in these times of economic uncertainty, considering how well a lot of these big companies are doing, my money's on these big names. My top pick right now for next year is Marvell Technologies based on an AI trade. The other name, I still love NVIDIA and AMD. I don't think the world is convinced, or the buy side community is convinced, that this spending on AI investing, on the chips, on the GPUs needed for this massive computing power is going to continue into next year the way it was this year. I think we're barely in the beginning innings. I think the same things were said about the cloud 10, 12 years ago. Same things were said about cybersecurity, and those have just continued to strengthen and strengthen, because right now, the spend on AI for at the moment is less than 3% of global tech spend. So it's an easy bar for them to grow, and it proportionally becomes huge numbers for them.
Also, Wall Street Journal pointing out that a record amount of Americans have market exposure, Mike, more than 60%, whether it's in direct stock holdings or through brokerage accounts or 401ks and retirement plans. More and more people waking up post-pandemic and realizing they have to be invested in this market in order to keep up with the raging inflation that we've seen. That's one piece of it, but that adds to the momentum as well. The other flip side piece of this is what's happening in the housing market. And I want to put up a chart because we see clearly from this that there's a deficit of homes right now. A deficit of more than 3 million homes is causing prices to stay pretty high as interest rates are high, too. This is something that we have never really seen before. Typically, when the rates are higher, the prices are supposed to go down. So what happens next in housing? And maybe is some of that extra income that might have been invested in housing going back into the stock market?
Yes. So post-financial crisis, there was almost a generation of Americans that decided they wanted to live in an apartment, live in a small home, live in a condominium near a community kind of on top of their neighbors, and that have that live, work, play feel. Well, in the pandemic, that turned on a dime. And so you had a decade of people that never really wanted to own a big home with a big yard happen immediately. And those that lived in a little home wanted a bigger home with a bigger yard. So the demand for housing, basically a decade data backlog just jumped right to the front of the line, took out everything, all the excess that was out there, and now we are in a bit of a conundrum because higher rates not only hurts home buyers, it also hurts developers and builders because most of the time they're not just in cash business themselves and they need to lever up to buy. So we're in a bit of a tough time for first-time home buyers, especially going forward without a dramatic economic drawdown. And one other thing that's interesting right now is that the difference between the 10-year Treasury and the 30-year mortgage has historically only been about 175 basis points. Now, you have almost another 100 basis points in there, and it's been that way for the last 6 to 12 months, based on the trouble in the banking industry, the excess and loan loss reserves, the deposit flight. So if that comes in and some of the banking industry kind of gets back to where it was pre-Silicon Valley Bank, you could see some acceleration in building, but it's going to be tough to afford a home for a while for a lot of people.
Yeah, that's tough for voters going into the election, too. Michael Lee, always great to see you. Thank you so much.